Your age has a lot to do with what you should be doing to prepare for retirement, especially with the income tax rates increasing. And if you're planning to retire around 60 years old, as an example, there are quite a things you should be doing when you're about 10 years out, when you reach about 50, which are quite different than if you're in another stage of life. Like if you're in your 20s, 30s, or 40s, you should likely start to shift retirement key contributions or start them in Roth IRAs or Roth 401ks. And really, to be honest, some properly structured life insurance plans are pretty good too to provide tax-free income, the only two instruments that truly provide them. So this likely makes the most sense for you if you do believe taxes will rise in the future. But of course, a review would have to be conducted on your specific situation to be sure the suggestion is right for you. I believe we can all agree, though, the world is as unpredictable as it's ever been in our lifetimes. And unpredictability is exactly what you don't want as you approach retirement. Unfortunately, in these volatile times, I think it's fair to say that we don't know what's coming next. As the recent coronavirus has taught us, it's not wise to wait for the next virus, war, natural disaster, or financial crisis to get your plan in order, because things can happen at any time. Now, let's look at a potential example of what it looks like for someone to wait who didn't plan for increased taxes. Numbers are always tough to discuss, so I'll speak a little bit more slowly. Let's assume you have $250,000 in a tax-deferred account like an IRA and you're 60 years old. Let's also assume you're in the 22% federal and the 8% state bracket for a total of 30%. If your $250,000 stays in that retirement account and doubles by the time of required minimum distributions at 72.5 and you have $500,000 and tax rates go up just 10%, how much more tax will you pay then? Well, $250,000, 30% is $75,000. At 72.5, $500,000 is $200,000. You've paid $25,000 more in taxes. If you would have planned, you wouldn't have had to pay that extra tax to Uncle Sam. Now, could you have this same type of gain in an account that's not tax deferred? Yes. In this example, you've gained $250,000 only to give away $25,000 more of that gain than you would have given away at today's brackets. What if taxes go up 20% or 30%? Now, the Congressional Budget Office of the United States has said, if Social Security, Medicare, and Medicaid go unchanged, the tax rate for the lowest tax bracket would increase from 10% to 25%. The tax rate on incomes in the 25% bracket would have to be increased to 63%. And the highest tax bracket would have to be raised from 37% to 88%. So it's very important to plan. We really don't know what's going to happen in the future. But again, we should be planning for all outcomes. Again, one fact remains, your tax-deferred account is a tax-ticking time bomb. You couple this with the volatility in the stock market and you have no plan, you really could be caught off guard. If you're ready to have a conversation about this, click on the link below and set up a time to chat. I look forward to hearing from you.